Hi there, are you a financial statement genius who can read your financial reports, know what they mean and make informed decisions based on those reports? Or do they make you break out in a cold sweat and you feel your eyes glaze over when the topic comes up? You're not alone, and don't worry, I get it. Confusion and uncertainty can lead to fear, which in turn can hold you back from achieving future success. But understanding your business financials is vital to making informed business decisions. So in this video series, I'm going to break down the most common financial statements and show you what the numbers mean, what to look out for, and how to use those reports to create future reports that can help you effectively plan. But in this video, I'm going to walk you through a typical business profit and loss statement. The profit and loss is one of the three key financial statements in your business, alongside the balance sheet and the cash flow statement. Let's dive in. It's a process of systematically recording, classifying and summarising financial transactions and events to provide insights into a business's financial health and performance. It's all about looking backwards to work out what profit we've made from our profit and loss over a period of time, and what our business assets are worth, which is our balance sheet, and how much tax we need to pay. That's our tax return. Your accountant will typically do these reports for you each year at a minimum. We will call these lag reports because they're lagging in looking backwards, and they're a measure of past performance. So these reports represent what's already done and dusted, and we really need to understand them. But also we can use them to form the foundation of some exciting reports that we can use to plan our future, make informed business decisions and reach our goals. Reports such as targets, forecasts and budgets, and they're based on your historical trading. But these reports, because we're taking our lag reports, looking backwards, and then we're projecting forward, we call them our lead reports, and they help us prepare for the future. And I'll cover these reports off in future videos. But in this video, I'll be providing an explanation of the profit and loss, how it works and how you can leverage it. And while at some point you might want to outsource your bookkeeping, it's so very important that you understand these numbers, as they are the facts on how your business is travelling. I often hear business owners saying that they don't understand or are even scared of looking at their financials. But remember, the numbers are just the facts. It's our interpretation of those numbers that causes our feelings around them. Two different people can look at the same set of numbers and have two very different interpretations of them. So let's strip it back to the facts. So what is a profit and loss? A profit and loss is a measurement of the profit or loss your business has made over a period of time. And it usually has 5 main components. So on this slide here is an example. So the first item is your sales or revenue. So that's your total sales of any product or services before any expenses. Then we have our cost of goods sold, or COGS, which is the cost incurred to deliver on your contracted sale. So some examples of cost of sales: direct labour, contractual or employed, materials, scrap for rework, packaging, distribution costs, commissions to salespeople are typically some of the things that we'll see in a cost of goods sold. So cost of goods sold will increase with the increase in sales volume because we have to buy more to supply more. Some businesses though will have minimal or no cost of goods sold if they don't sell any products. Their profit and loss statement won't include that line. Businesses such as accountants, business coaches and things like that don't really sell any product, they're just selling services. So your sales less your direct costs or cost of goods sold will give you your gross profit. And we can use this gross profit to calculate what your gross profit margin is. So gross profit margin is worked out by dividing your gross profit by your sales, which gives us a percentage. And this percentage shows you the amount of money you're making from each sale, the percentage of each sale. For example, if you sell a dress for $100 and it costs you $60 to produce that dress, your gross profit per dress is $40 and your gross profit margin is 40%. So this is a very important concept to understand, and it's important to make sure your gross profit margin works on paper, because if you're making $40 per sale and your operating expenses, which are more than this, you won't last long in business, unfortunately. The higher the gross profit margin, the better, as your business keeps more from each dollar of sale. Next in the profit and loss, we have our overhead or operating expenses. So these are the costs that you're going to incur regardless of whether you make a sale. So that includes things like interest on loans, rent, insurance, electricity, water, office supplies, office salaries, advertising, cleaning, motor vehicle expenses, etc. So these are often called fixed costs, and fixed refers to the fact that these costs occur regardless. They remain constant despite your sales volume. So if we've got our gross profit and then we take away our overheads, that equals your net profit or loss. And that's the amount, or your net income. That's the amount that's left over from your gross profit after paying all your operating expenses. And this is what you get to keep. Your profit and loss statement should be prepared at least monthly to track your business performance. So let's take a dive in to see how you can use your profit and loss to improve your business performance. So there are 3 key areas that you can directly impact on your profit and loss. And the first one being your revenue or sales, the second one being your cost of goods sold, and lastly we have overheads. Improvements in any of these 3 areas will increase your net profit and how much money your business makes for you. They are the golden triangle of your profit and loss. So first, let's have a look at revenue. What can we do to increase revenue? Firstly, the easiest thing by far is to increase prices. Most small businesses haven't raised their prices in quite some time, and they may be scared to do that because they think however a smaller price increase, it will attract a mass exodus. Most small businesses haven't increased their prices for some time. They're scared to death that any price increase, no matter how small, will lead to an exodus of all their customers. But let's say you sell a product for $100, it costs you $60 to supply that product, and you decide to increase that price by 10% to $110. A few may leave, sure, but they're most likely your biggest price shoppers or tire kickers, and they don't show any loyalty or patronage to your business. They're merely shopping on price. So even though there may be some customer attrition, to what extent? The business is now making an extra $10 per unit of sale, all of which is profit. And of course, if you are thinking of doing this, please err on the side of caution and test the area on a small scale to see what the reaction is to the price increase, but there probably won't be much. So there's simply no faster or easier way to generate additional revenue than raising your prices. So another option to increase our revenue is that we can sell more, which is the tactics that we can use to do this. We can implement a new marketing program, but that takes time and money. We can look at other businesses that serve the same market that you do. And can you set up referral arrangements with these businesses to refer the like-for-like clients? Then we can look at upselling, cross-selling, and yep, that's a good old would you like fries with that. We could also look at downselling. Do you have a lower price point service or product for clients or customers that can't afford your premium or regular product and services? We can look at bundling. So bundling a unique set of services can remove price competition, or could you introduce additional product and services? All of these tactics will increase your sales, but only raising prices will flow directly to your bottom line. So the second area then we can use to improve our profitability is looking at our cost of goods sold. What does it cost to produce the product that we sell? So you could negotiate with your suppliers a different price or pricing model that works in your favour. You can look at productivity improvements. You can improve stock management and wastage. You could look to automate some processes and control wastages. By reducing the cost of your product, you'll increase your gross profit, and that will flow down to your net profit. And lastly, we can look at reducing our overhead costs. So we can review and negotiate rent agreements, embrace technologies for efficiencies, and make sure you're not paying for subscriptions you're not using. One of the things I like clients to do is to look at the credit cards and see what recurring subscriptions are on there. Are they using them? Because so often we get these small subscription amounts in monthly and it's just all too hard to cancel them, but over time they do add up. Also, we can look to review our contracts for phone, internet, printers, etc. to see if you can get a better price. There's always seems to be a better deal. The most effective way of reducing your overhead will flow direct to your bottom line. So it is a very efficient way to increase your profitability. And also increasing your prices and cutting costs always returns 100% to your bottom line. So if you compare this to increasing your sales or reducing your cost of goods sold, that will only add 40% to your bottom line because our gross profit margin is 40%. So only that percentage will flow to the bottom line. So we've covered off the basics of your profit and loss and talked about some strategies to improve your profitability. In our next videos, along with discussing the reports we can build from our profit and loss, we'll take a deeper dive into the strategies to reduce your cost of goods sold and overhead. So I hope you've learned some principles here that you can apply to your business. And in the very next video, I'll walk you through your balance sheet, what the numbers mean and what to look out for. So click to subscribe and make sure you don't miss out. Bye for now.